Welcome back for the second panel discussion, which I have the honor to chair. This second panel has a bit of a different perspective. We are now looking to the impact on the financial sector and the impact of prudential policies on the sector in the so-called new normal. Tomorrow, it's exactly 10 years that Lehman Brothers went under. I think it was the 15th, but we celebrate it today because I suppose no one will come back tomorrow. Since then, a lot happened, and that was urgently needed. There was a global overhaul of the financial framework. It was much more than just Basel III. The regulation changes dramatically, supervision, institutional framework, instruments of supervisors, and the like. We will now try to assess where we are in terms of repair of the financial system. It's clear that a lot happened, both, let's say, on the public side, the regulatory side, and in the industry itself, in the banking sector. But the question is and remains, is it enough? Is it sufficient? And is it right? What are the missing links, or what are the weakest links in the new framework? And what is the impact of all this on the banks and their business models? That is what we will discuss during this session. And we have a very distinguished panel to bring this forward. I will make, and it will make my task quite easy. As in the previous panel, and in order to gain time, we will not go through these CVs, otherwise the 75 minutes are over. They are all well known. It's a more Belgian panel, but nevertheless very international oriented. We have two renowned academics, Rudi Vander Vennet and Mathias Dewatripont. Mathias has also experience in central banking. He was member of the Basel Committee and the Supervisory Board of the ECB. We have Christine van Rijsseghem, CRO of KBC Group, and we have, last but not least, Isabelle Vaillant, Director of the European Banking Authority, representing, let's say, the public sector from the regulatory point of view. In the first round, we will have first presentations with different perspectives. Each panelist will develop, let's say, one storyline of about 10 minutes. It will be complementary presentations. Let's start with that, and then we take it from there. The first one will be Mathias, and Mathias will focus on what he considered, I think rightly, one of the, let's say, weakest point in the current framework, that is the current European resolution framework. Mathias, the floor is yours.
Thank you, Jo. Thank you for the invitation to this very nice conference, a very nice panel, and it's also good to be back home since I had. Okay, so sorry. So thanks for the invitation for this very nice conference, and as I said, it's also very nice to be back home. I spent 6 wonderful years at the National Bank, and so I even said it's the National Bank of Belgium conference, but sorry to SUERF and to Belgian Financial Forum, but I was a bit not precise enough. So I was asked indeed to talk about bank resolution and bail-in, which is a specific aspect of the current question, are we ready for the next crisis? Let's put it this way, banking crisis, if it comes. And I think, as we know, we want prevention, regulation, supervision, and then we want crisis management in case it happens, because as we know, even though indeed we have done a lot, and the probability of a crisis is reduced, on the other hand, we can never exclude the potential of a new crisis, especially in a world where we have political risk, where we have technological challenges, and so on and so forth. So Let me connect this question of resolution and bail-in to the bigger picture. In terms of principle, what we should have to always remember is that banks are special because they transform maturity. We want deposits on demand, and we want 20-year loans to finance our houses. And so this, in particular, can lead to problem. Especially given that banks are also special companies where, in contrast to other companies, creditors very often don't do their job, because creditors are you and me, and okay, we are better than average, but still we don't see our job as looking at what our bank does with our deposits, and so there is no discipline, and so the discipline has to come from regulation. So we address financial instability through deposit insurance, for example, but of course that only applies to the least volatile deposits, which are the retail deposits, while the crisis, the Lehman crisis, was a wholesale deposit crisis, and they are not insured, and they shouldn't. And then, on the other hand, we want to address moral hazard issues through capital ratios, credible resolution, and I will focus on that. But we should always remember that when we do two, so addressing moral hazard, we don't create problems for one, financial instability. And so the key principle, and I think if there is only one message I want to convey today, is that a good resolution process is one that concentrates the pain on investors whose funds are stuck in the bank. Okay, so basically, of course, as a shareholder, you can always sell your share, but not sell it back to the bank. You have to go on the secondary market, the stock market. And long-term debt, the same. There may be secondary markets, but you cannot get the money directly out of the bank like a deposit. So I think that is the overarching thing, because financial instability can be very costly. Now, what happened in the crisis? We had under regulation. The fall of Lehman was a significant worsening because it was the first time that it was not only shareholders losing money, but also depositors, wholesale depositors. And that triggered a change in equilibrium. In the beginning, everybody thought my bank is safe, I don't have to worry about that, to a point where every bank could be the next, including banks that had very little connection to Lehman, like, for example, Fortis or Dexia. So that was, I think, a huge wholesale funding bank run. And the response was no more Lehmans, no more disorderly resolution. Instead, let's significantly rise retail deposit insurance, which is a bit funny because this was not a retail problem, but a wholesale problem. And also massive bailouts and re-regulation, as was said, Basel III and others. I think globally it went in the right direction. Definitely we needed more capital, more liquidity, and so on. Let's face it, it's still largely untested. By largely untested, I mean, if a macro crisis comes, how will the system deal with it? There is this debate on where are we, is Basel III insufficient, just right, or excessive in terms of capital ratios. It's interesting that we have this debate. I still think that we could go a bit higher. We'll come back to that. But that is not just the whole picture, because all these other innovations that are untested. Now there is this idea of let's extend, let's make sure that creditors who are not insured also participate in loss absorption if there is a problem. Because the big problem in 2008 was that only shareholders lost money and not creditors. So I think it's, at some level, this debate is a bit of a paradox, because Basel III was all about quantity, but not only that, also quality of capital, i.e. shares, common equity tier 1. Clearly, we have gone so far with Basel III there is now this view that since we don't want bailouts anymore, which I think is right, we can think about this bail-in. So these private creditors, so not shareholders, losing also something when the bank is in trouble. And that even in systemic stress, by the way, as we will see. I think on the one hand, politicians rightly feel that they want to protect their taxpayers and that Basel III may not be enough. I think they are right on that. However, what we need to keep in mind is that financial instability can be hugely costly, and you don't want to, by pushing that line, to endanger financial stability. And it's a debate relevant both at the world level with so-called TLAC, but also in the EU with the Banking Recovery and Resolution Directive and so-called MREL, and I will focus here on the latter. Now, basically, the point of BRRD is that politicians have decided that now you cannot put €1 of public money, whether European, which I understand, or even national, if you haven't bailed in 8%, so expropriated, 8% of the balance sheet, 8% non-risk weighted. So twice the amount of capital banks have. So you need roughly. So you need to find creditors to impose losses on before you can start putting the public money. This is, by the way, what happened in Lehman. Lehman was a bail-in thing. Of course, it was so-called disorderly, but you know it was a disaster. So let's make sure it's not a new Lehman. Because if indeed some people think, oh my God, I may be at risk, then they will, if they can, they will take their money out of the bank. And so that's exactly what happened after Lehman. Now, the bottom line is that, and we can come back to this in the question time, but while we have imposed this 8% rule, banks on average in Europe are far from having 8% of long-term junior claims that can be expropriated before you hit depositors. And so I think, now the system is untested, we will see, but I think what we need to do is, my preferred solution would be to make sure that quickly all the banks in Europe, because this applies to all the banks in Europe, the 5,000 or 6,000 banks in Europe, that all the banks in Europe have enough, have really 8% of their balance sheet, which is long-term junior, so that will not put at risk the rest. And we are not there yet. As I say, nobody wants bailouts, so, but the point is that there can be things that are worse than bailouts, and that is financial instability. As I say, Lehman had no bailout, and it started this huge crisis, while after the crisis, the US had a bailout of more than $400 billion, so-called TARP. Everything has been repaid. Now, as Christine could tell you, Flanders and Belgium, the Belgian government loaned 7 billion to KBC, and let's face it, Belgium and Flanders had a good deal on that because KBC was a healthy bank with problems at the time. Of course, the markets were freezing and so on, but if you do it well, if you lend money when you're the only one willing to lend money, you can ask for good terms. And if the bank is in good shape, it can repay a handsome amount of money. Now, with Dexia, it won't work, unfortunately, because this is not, so it's not a panacea, but the point is that you have to think about the alternatives. And as I say, bailout is never first best, but it can be, there are much worse solutions if badly designed. So that's my point. And so it's all about this so-called orderly resolution. Lehman was disorderly and therefore it was a mess. But defining orderly is not that easy because in particular, well, let's face it, depositors will run if they can and they feel their money is at risk. And the problem of Lehman was not the depositors of Lehman, they were stuck. Once you decide it's bankrupt, you can say no more withdrawal of the money. The problem was the depositors of, for example, Fortis and others that thought, oh, are we next? And we are not yet in resolution, therefore we can leave. And that is, I think, the key thing that should be kept in mind. So let me not get into some examples of how this can work, but we can come back to it. Now, as I say, we are not yet at a solution that would guarantee that this 8% bail-in rule would not trigger financial instability. Now, some countries have moved a lot towards in that direction, and for example, Germany has decided, that was a very strong decision. Now, lawyers may not like it, but they decide to make senior bank bonds junior to other senior debt retroactively. The retroactively that lawyers don't like is all of a sudden there were these guys who were holding senior bonds that were, senior doesn't really mean senior anymore, it's junior to other stuff. But the good news is that these guys, if a big German bank gets into trouble, you can impose losses on these guys and they are stuck. Now, they may not like it, and obviously, but the point is that they cannot trigger the fall of the system by leaving. Now, this problem is being recognized. I think it is being addressed much too slowly. We already have this 8% rule since January 1st, 2016, and thank God it has never been applied yet, in the sense that we have always managed, and there were these three famous cases in Italy last year of banks where we basically got around BRD by not imposing losses on. We didn't impose losses on depositors. I think we were right, but let's face it, we got around the BRD, and I think it's good to do that if you're not ready yet to have a serious BRD. The problem is what happens when we have a systemic crisis, because these three Italian banks, they were just, the bad guys. They were less good than the rest, but the rest was okay. The real test for banking regulation is what happens when you have a macro crisis. And these things tend to happen. So as I say, this is what I said about this chosen route. The point is that we are right now at a system where the banking system in Europe is much better than 10 years ago, but as further data will show, especially from Rudi, we are not there yet to a fully healthy system, even though some banks are pretty healthy, like KBC, for example. So we would need to clean up the system. We are not ready to impose bail-in. We don't want bailout. But, as I say, when bailout is out and bail-in is not in, denial is the only option left. And that is, frankly, there's a lot of evidence showing that our unwillingness to clean up fast enough the banking system in Europe is costly in terms of growth and GDP, and I think but this is a political thing. There seems to be unwillingness to either do some bailouts to clean up or to impose losses in a sufficient amount of long-term assets, and there we are. Thank you.
Thank you, Mathias, for this very convincing story with structural shortcomings still in the system. But there is one optimistic point. The European legislator can fix the problem, if you wish, so in the next round of the legislative banking package. Now we turn to Isabelle. Isabelle will present what was the impact over the overall of the framework, added a lot of complexity, and what does it mean in terms of proportionality for the different business models. Isabelle?
So thank you very much, Jo, and I'm very happy to be there. I think it's a very timely conference at the time that we have, I hope, reached a new normal, but I'm not sure it's quite finished new normal, but at least what I can say is that this is a very good step that we have achieved on taking out uncertainty regarding regulatory reforms. We are supposed to be done. I spend all my days making sure that this is done. And this is, I think, a great deal that we can offer this kind of certainty and regulatory pause. It's much needed in my view to take a step back and make sure that now we can start using the new norm. So this stability is very important that we get to. I think in Europe we even had this gold aim of having the single rule book. So I hope this new tool achieves a great deal for our stability in the banking system. So I will take you through first all the positive side that I can describe. I hope all the panel would agree, but let's see. But I would also like, as you said, to highlight some of the challenges which are still ahead with the new norm and its implementation, as a matter of fact. So all the positive I gathered basically in this slide. I think it echoes what we heard already from Jan in the first instance, and also Governor Smets. So the system is definitely more robust. I think what was very important in the first instance for the European banking system is to get its capital of high quality. So we aligned all on the substance. This is very important. For years we had been challenged from the outside about the quality of our capital in banks. And I think it has been a very great achievement. And as a matter of fact, I also spend quite a deal of my efforts together with you to maintain this quality every day, because it's a vigilance of every day. The levels, I think Mathias commented upon already. So we can go further, but it has been already a great deal. And it's important to make sure that markets recognize this enhancement. In terms of robustness, there has been plenty of revisions on the basic metrics for prudential regulation, the credit risk, the market risk, and so on. What I would like to highlight here is this balance which has been reached, I think, among some more risk sensitivity. Sometimes we forget about that, but this is the case with market risk, where we change completely how we approach the market risk, and this is a way to have a much higher risk sensitivity, but also important, in my view, that we match the business extension. So there is this alignment with how the regulatory framework functions in regard as the business in kind of a use test, I would say. On the credit side, it was the contrary, because as you know, we had relied for long on internal models already, and the issue was more to take out the so-called undue variability. So why the capital requirements would be double or half for a similar bank profile in credit was a bit striking. So we had to take this out. And this has been done with thorough thinking how to constrain the internal models. And of course, how to set up a backstop with the output floor. So I think the arbitrage risks have to a great deal been taken out. Very important also is the broadening in the scope. So they are striking new risks that are under coverage. So the leverage risk has been mentioned already. We are now stepping up how to approach this new risk in the implementation phase. We have liquidity, which to me has always been and will remain a very key risk, in the sense that it is the early warning, if I may say so. It never happens that a crash does not start with liquidity stress, so we have to be extremely vigilant on this. Also, I could add encumbrance, which I think will be very important to have a look into in the future. And the last striking feature of this new norm is that we instilled some flexibility and forward-looking appetite, I would say. It's not so striking, but it's there. So it's a new option beyond the traditional, I would say, judgment of the supervisor using the Pillar 2, which I think is still extremely important, obviously. But now, even in the rules, I would say, in the beyond judgment, we have a resolution regime that Mathias was commenting upon already, and the macro prudential policies which are interacting with the micro. So with all this, we have built a strikingly different regime, I would say. I will also comment that we may discuss the impact, the overall impact on the capital requirements. It's not much, in my view, maybe 10-12% all in all for the European banking system, which is fully fitted to go even over. So there should not be any difficulty reaching this point. Now, to share with you the challenges to come. So I think the first one that we face is that all in all, we did our best, but the thing that we have in front of us is quite complex. The Basel Committee has been adamant in reducing complexity. I don't think we have succeeded in this regard. When I started banking supervision, okay, I must admit it's quite a long time ago now, but I was working with 10 pages. Now, I personally, even though it's my daily job, I don't know all the 10,000 pages. So this is a challenge for bankers, obviously, for the addresses, but this is also a challenge for the supervisors. So we have to think hard how to solve this issue. I think with the banking union, we have equipped ourselves in Europe with a kind of an organization which can overcome the complexity that we have to face. So it will kind of help. We have stronger teams, more coordinated teams. We can share views. So this organizational aspect will definitely support that we can face the complexity. On the other hand, we also have to answer how to build the necessary proportionality and how to simplify rules where we could. The problem I see is on the right side of this slide, is that when you go to this route, it's not easy to simplify and still be fair to the risk or to the level of the capital. So this combination between the one-size-fits-all simple rules, perhaps more expensive rules, but go to proportionality and then have, in the end, a bit more complex rules even, is the dilemma. So this challenge that we have, and this is specifically, I think, a turning point for Europe to think about, is whether we should indeed to a more business model approach versus a tiered approach. The tiered approach is the one that I would qualify operates in the US, basically. And today we are also faced with this challenge that we have to think about how to do in Europe. The credo in Europe is that we have had to build a single market, and we should certainly continue deepening it, I would say, deepening it. If we have an analysis of the regulatory impact nowadays, it's very important that we continue assessing how it affects the different groups of banks with this forthcoming regulation. And also that we have this business model analysis and vigilance about proportionality. We have done this, we are in the early days of doing this. We have produced advice to the Commission and co-legislator, for instance, with the new metrics like the leverage or liquidity ratios, in a very disciplined manner, how it could affect this or this type of business model. I think this is worth doing, and we should put some strength in doing that. Also, in my view, not only this would help the micro views to be more effective and assess also better the performance of each kind of bank, but also it would help getting a more macro level understanding of what are the trends. So it would help us deepening the single market in a true manner. So this is, I think, something that we have to tool ourselves with for the next step. I will not comment so much upon the last two slides, which are quite quantitative and more for illustration. What is interesting is that in Europe, this business model analysis take into account differences into countries, which is always important to get to, I would say, fair compromises, and also the balance between what you put at European level or what you leave at in the subsidiarity level, I would say. So it's also a nice path for us to undertake if we want to deepen the single market in a fair manner. Last point of mine would be that as I said, we have starting reasoning the impacts of the new regulation about this categorization of the credit institutions. It helped us specifying some priorities and also scrutinizing the solvency as well as the resolvability. The categorization is difficult to do. Okay, but we already have some I would say, requirements that we have now as reference. But all in all, we must remember that in Europe, and these charts illustrate that we are going through universal business model everywhere. So we have nothing to compare with the US in this regard. We have some large wholesale business or investment banking, but not on their own most of the time. So in any case, we are going through this universal business model. What I think is the next challenge that we have to look into is what beyond this universal business model, what is happening there. It has been mentioned already, the organization of the fintechs. The fintechs, they are doing payment services nowadays, mostly, but they are extending also credit progressively. So I don't know how the interaction with the other business models have to be looked into. And in general, I think the shadow banking remains a big issue that we have also to tackle.
Thank you. Thank you, Isabelle, for this comprehensive overview and pointing also on the challenges ahead. The 10% leverage ratio is simple but not very risk sensitive. Okay, let's now turn to the private sector, and we have Christine from Rijsseghem for this. She will tell us the, let's say, the success story of KBC. KBC went through a difficult period together with some other banks 10 years ago, but you will explain the story about the recovery of your institution.
Thank you very much, Jo. Good morning or good afternoon, ladies and gentlemen. Pleasure to be here and to be invited and to give you a bit of insight of what we have been working on in KBC over the last years. As it has been mentioned already this morning several times, we all know that trust is, of course, fundamental to our social license to operate. And during the financial crisis and also in the process of the crisis, we have seen that this most valuable asset became also the biggest casualty. So what have we been doing in KBC? In 2008, we have indeed received the first state aid, complemented in 2009 by a second state aid. In 2010, the European Commission approved our new strategic plan, and there the main purpose was to focus on our core markets, i.e. Belgium, Bulgaria, the Czech Republic, Hungary, Ireland, and Slovakia. That divestment program decreased our risk-weighted assets with 40%, 40, strengthened, of course, our capital base as a consequence of that, and also our liquidity position. In 2011, we already started to repay some of that state aid. By 2014, the divestment program was completed, and in 2015, we also completed the repayment of the state aid. As Mathias has mentioned, we have received 7 billion of state aid, for which we were and still are very grateful. We repaid penalty, we repaid, of course, the principal, in total a bit more than 13 billion. But we did not only work on the financial ratios, we also worked on other topics. And one of the topics that we focused on quite immediately was to strengthen our risk management. And in 2010, we launched the so-called Risk Harbor strategy, where we established fully independent CROs. You know that before that, we often combined CFO and CRO roles. These were split, these functions. We installed fully fledged local risk teams and also some group risk departments. And quite quickly, and this was re-established in 2013, we also established our risk mission and vision. And I have listed this here on the slide, and I would like to read this for you, not to be poetic, but to stress the importance of this. Because within KBC, we want risk to be in the hearts and minds of everyone. And this for KBC to create sustainable growth and to deserve its customers' trust. Why is this so important? It is important because it needs to be in the heart and minds of everyone. So not only the second line of defense, but certainly the first line of defense, the business. And of course, as every business line, and that is also the same for a risk department, we continuously update our mission and vision, taking into account external environment and external elements that we see. We did not only strengthen our capital base, not only our liquidity situation, not only our risk management, but we also worked fundamentally on our corporate and risk culture. And of course, we all know that trust is based on competence, on open communication, on personal integrity, and on truly taking care of all our stakeholders. Within KBC, we sum this up, our business culture, in the acronym PEARL: performance, empowerment, accountability, responsiveness, and local embeddedness. And this, ladies and gentlemen, this is in hands of each of our colleagues. And there are some colleagues here of KBC in the room, and they know this, that is the result of many decisions we make every day on a lot of dilemmas that we need to face and where we need to balance all the interests of all our stakeholders. It is, of course, about company culture. It's about behaving in a responsible manner. And then not only looking to the letter of the law, as we say in Dutch, but also to the spirit of the law. And everyone has its place there. Senior management, of course, needs to create the right environment for nurturing this right behavior. Each employee is also responsible for showing this awareness to this. And we at the risk level also need to develop appropriate policies. It's about speaking up, about giving open feedback, learning from mistakes, taking accountability, tone from the top, very important, having a correct remuneration system, and last but not least, also diversity, and diversity in all kinds of forms. But promoting this individual integrity is, of course, crucial for inducing the cultural change at the firm level. But for this change to also take hold at an industry level, other stakeholders need to step in, because this is a collective responsibility. And of course, this brings me also to the role of our regulators and of our supervisors, because I also firmly believe that they have and they can play an important role in this respect. Regulation, ladies and gentlemen, has the ability to affect individuals' behavior. A good regulation, a robust governance are key to this. If the regulatory and the governance framework provides incentive for inappropriate behavior, you as an individual, even the best meaning individual, cannot find a way to promote an ethical culture. I do believe that the financial reform agenda is appropriately focused on the regulatory and on the governance framework, and that we have made good progress on this. In KBC, for instance, we have also worked on this with a very clear segregation of duties and responsibilities between Board of Directors, Risk and Compliance Committee, Executive Committee, also our internal controls with the fully fledged 3 lines of defense, and also, as already mentioned, in risk management. Let me, in the last couple of minutes, take you a bit through the experience that we have with regulation and supervision, and perhaps you, if you allow me, also to give some elements where I believe that we can still make progress on this important topic. We are an integrated bank insurance group, operating in different countries, as I have mentioned. We still face a lot of challenges in terms of walls between insurance and banking regulators. But also we see that between local regulators and also more European supervisors and regulations, there are still different attention points. And that is not easy for a group to operate, because you need to comply with both of them. So how do you do this in the group? A second element is that, and I know this has already been raised at several occasions, I think that we need to avoid overregulation. And I will be the first one to say that I believe we were a bit underregulated, but now we have to avoid overregulation. And I often illustrate this here by using this curve, the Laffer curve, and I think that with this distinguished public that you all know who Laffer was, but he was trying to demonstrate the relationship between, on the one hand, the levels in terms of tax, and on the other hand, government revenue. And beyond a certain point, it becomes suboptimal. So let's avoid that regulation becomes suboptimal. And I do a call, and Isabelle has already also mentioned this, for simple, for clear, for stable regulatory and supervisory requirements, taking also into account the customer's view. And if need be, I can go into some examples in that. And let me summarize by saying that on the one hand, I think that indeed the regulators and also supervisors have delivered fine work in a number of areas, such as the increase in risk awareness, putting constraints on exotic financial products. So this is certainly an improvement. If I can make some suggestions on the way forward, that is one, create a regulatory level playing field between incumbent financial service providers and new players. We are very much in favor of a single supervisory approval across a range of activities, same regulation for same activities or services. 2, use regulation not only as a defensive tool, but also as an offensive tool. The sector is having a lot of challenges that we need to tackle, a lot of competitive challenges. So the regulator can stimulate innovation in the sector rather than creating restrictive frameworks for existing financial services. And then 3, perhaps, I have 6 of them, but I will limit myself to 3 in benefit of time. Also, data alignment. Data alignment amongst the different authorities. We all know that data intelligence is paramount, but it is so important that for us to have a kind of one data set, one common basis coming from the different authorities. The data requests that we get in, they share a lot of many characteristics, and I think we can achieve a lot of synergies. I would like to keep it there, Jo, for the time being.
Thank you, Christine, for this sharing your experience within your group and also for providing some messages. We definitely will come back on some of your recommendations and messages. Now I pass the floor to Rudi, who will give an overview of the impact of all this new package of regulation, this overall, what it means for the different business models.
Thank you, Jo. Thanks for inviting me on this nice panel in the wonderful room with this wonderful audience again. I was asked to say something about bank business models, and that will be my topic. I have quite some slides. I will only be able to focus on a couple of issues, but you have them in your documentation, so you can read them at ease. The main argument will be that, well, there is no one single superior business model, but that is no surprise. If I look at a couple of indicators, especially market indicators, quite some banks are still very vulnerable. I fear you that this day will not be a very happy day in terms of conclusions. Everybody is pointing at difficulties still ahead of us. And so a lot of restructuring is still coming, and the question is, of course, what direction will that take? If I would summarize the impact of the regulation on banks, I think there's agreement that in terms of regulation, it's mainly Basel III that has a big impact on all parts of the bank balance sheet, as you can see in this slide. And from the macroeconomic point of view, it is mainly the unconventional monetary policy of the ECB, compressing interest margins and having impact on asset prices. And so the expectation was, when all this happened, that banks will fundamentally review their post-crisis business models and make fundamental choices in terms of, I have the list here, asset structure, what do you do? Funding mix, we see more deposits, more capital, where do we go? In terms of revenue mix, not only interest but also non-interest income, and in terms of geographical scope. There's been a lot of fragmentation behind national borders. Can we reverse that? The question is then, which business model is the best? And so there has been a search of research, both from the academic side, and my team has been involved in that, but also from regulators and supervisors, BS, ECB, EBA. Isabelle just showed us some of the results. And I think 2 facts emerge from that. First of all, that business model migration appears to be very slow, and also that the weak post-crisis operational performance is still visible in all these business models. I'm going to show you some of the examples. Sure, we've seen, and there's no surprise, an increase in, for example, retail funding. This comes from the BS. I usually include references. If you want to look it up, you can. The red line is retail funding. We see that. But also, and look at the right-hand side here, there is some sort of what I call a great convergence of profitability, and here I measure it by return on equity, for all business models to sort of new normal, somewhere between 5 and 8%, something like that, with some exceptions, and one of the exceptions is at this table. And if you then look at business model transition, and this is taken from a recent financial stability review of the ECB, look at the right-hand side, transition is very slow. I summarize it like this. On the left-hand side, you have a classification of business models. This is just one. There's many others. And on the right-hand side, you see the evolution from pre-crisis to now. what strikes you is that there has been very little migration of business models. Sure, we've seen that the international banking industry has been shrinking somewhat. We have become more national, but for the rest, you don't see that many changes. Yet, the pressure is on, I would argue. If you look at profit indicators, and especially at the market assessment of the banks, this is a demonstration that what I put there very politely, not all banks are viable. Some banks are simply not viable. I show you two elements. We can look at the cost of equity, which for listed banks can be estimated, what shareholders require as return, and then you look at return on equity. Return on equity has to exceed the cost of equity. Well, for many European banks, that's not the case. I'm going to show you. And for listed banks, another indicator is the market to book value. Market value has to be larger than book value in order to be viable, of course. If I then look at the latest EBA, and Isabelle is here, survey of the banks in their risk assessment reports at the questionnaire, the question is, what do you think your cost of equity is? This question is put to the banks. Most of them, you see the numbers here, say it's between 8 and 10%. So far, so good. In the same survey, they asked the banks, what do you think your long-term return on equity can be? And again, look at the numbers. Most banks put it between 10 and 12%, and some even above 12%. Something like 70% of the banks say it's going to be above 10%. This appears to be relatively comfortable. Return on equity will exceed cost of equity. Okay, but then I look at the actual numbers, again from the EBA, and I look at the top line, last column, the most recent observation, who is already above 10%? Well, 90% of the banks is not, except a few, and one is at this table. So I would argue a bit cautious here. We're certainly not there yet. And then the market to book value story, again, as I said, one is sort of a natural benchmark. You need to be above one to be viable. Since the crisis, you see some positive evolution for a number of banks, and I just list here a couple of well-known banks from different countries. Those above one are typically the Scandinavian ones, and then a couple of Dutch and a Belgian bank. Again, sorry to repeat myself, KBC is there, doing really well, exceptionally well. But many other banks are still way below one. This, ladies and gentlemen, is reason for concern, because it means that banks have become safer, but their fundamental operational profit capacity is still not recovered. And so the next question is then, what can banks do? What actions can banks take? And this slide tries to summarize the picture. On the left-hand side, you have the impacts on the banks. Regulation and the macro environment are the most important ones, but also competition, fintechs, etc. And then on the right-hand side, you see potential remedies. What can banks do? And again, there's too many here to go into detail. I will mainly talk about three of them. First of all, loan pricing. I think adequate loan margins are key to restore viability, not volume, but margins. Second one is operational efficiency. Typically, we look at cost-income ratios. There can be no compromises there. That has to improve. Productivity in the banking industry has to be stronger. And then I will say a few words on revenue diversification. Everybody talks about moving away from pure interest income to fees, but I guess we will have to go beyond that, beyond traditional banking, I mean. Let me first focus, this is the summary, let me first focus on the margin question. I think we all agree unconventional monetary policy of the ECB has compressed bank interest margins. That's clear. But it is also interesting to decompose those interest margins. And I will try to look here at the lending margin and the deposit margin. And the graph I have here is for the Belgian banks. I took it from the statistical data warehouse of the ECB. But pretty much the similar graph can be drawn for all other countries. It's a bit difficult to see, but I will go into this. You have the blue lines are the lending rates. And then I have the swap rate to calculate the lending margin. And the black lines are the deposit rate and then an interbank rate. If I use colors, this becomes my picture. The blue one is the lending margin that banks apply, and the gray-black one is the deposit margin. Do you see the evolution from pre-crisis to post-crisis. 2008, of course, is the inflection point here. Before the crisis, banks had, this is the gray part, a very healthy, positive deposit margin. Banks were earning money on their deposits. But on the other hand, their lending margin was shrinking, caused by lax lending standards. We now know, with the benefit of hindsight, banks were giving too easy credit. They were taking too much risk for too small margins. 2008 reversed all that. Lending margins went up, deposit margins down. Deposit margins even become negative, as you can see, because of the zero lower bound on deposit rates that banks can apply and the negative rates on the interbank market. There's even a negative deposit margin now. That is compensated to a large extent by increased lending margins, the blue part here. Risk-based pricing, I would call that. The question now is, what will happen when interest rates go up? I'll keep it here. When interest rates go up, as we heard from Governor Smets, it will take some time, but eventually interest rates will move up. What will then happen? How will banks react? In terms of lending margins, will they keep their risk-based pricing, or will they go back to the pre-crisis lax lending standards with these narrow margins? That is the basic question. And I would argue that not only default risk, but also interest rate risk that has become larger, liquidity risk, we now know that that is in the market, but also the greater capital coverage have to be reflected in the margins. So it is margins that are key, not volume. And if I look at what is happening today, I see exactly the opposite. I see banks compensating lower margins with big volumes. I think that is not the way to go. I think here macro-prudential authorities should step in. Governor Smets mentioned the inaction bias. We have to be careful to avoid that inaction bias. So that's on the lending side. On the deposit side, I'm equally worried. Banks think that once interest rates go up, they will be able to return to these healthy deposit margins that we had before the crisis. I'm not sure about that. That may be an illusion, because I think the sensitivity, I wrote it down here, the sensitivity of bank deposit rates to the ECB policy rate may have increased post-crisis. And so the pass-through of policy rates into bank deposit rates will be much faster than before. Why? Because of technology, of course, and because there is so much competition for deposits. Every bank has to obey net stable funding ratio requirements, etc. The competition will only be bigger. And my main concern comes from seeing this report, very recent report by the ECB, a stress testing exercise. Everything has to be stress tested these days, including interest rate risk in the banking book. The ECB ran that for all European banks under its supervision last year, and it came out a couple of months ago. What worries me most is the 7% there. Only 7% I read of model deposits take into account the possibility that deposit stability may decrease. In other words, that the pass-through of policy rates may increase. That means, ladies and gentlemen, that 93% of the models that banks are using to price their deposits are based on period of only declining interest rates. What will happen when interest rates go up? I think it's going to be really different. Are the models accurate? I have my doubts. That's the margin part. Of course, banks will have to diversify, and they already do that. And non-interest income is becoming more important. But if you look at the left-hand side, it is a graph again taken from the ECB. It shows you fee and commission income and total income. It is increasing, but very, very slowly. And I would argue there is no unlimited pool of fees and commission income where every bank can profit from. So this will require choices, fundamental choices by the banks. Not all banks can do the same. There will have to be diversity in diversification. And then on the operational cost side, I think, again, there's no doubt banks have to improve that. But here again, the evolution is relatively slow, you know. Banks say we have to get our cost-income ratios below 60%. That seems to be the target, and then below 50% over some time. But if you look at the actual numbers, and again, I take them from the EBA, look at the bottom line, How many banks are still with cost-income ratios above 60%? It is more than 70% of the banks. So yes, there is some evolution, but it is slow. And simply cutting branches and laying off personnel will not do the trick. It will have to be about fundamental redesign of bank intermediation beyond traditional banking, as I put it. This slide summarizes the whole thing. I'm not going to repeat myself. You can read that for yourself. So the conclusion is that restructuring is happening, but it is going very slow. I think we need to accelerate. Most business models are still under pressure. As we heard from the other participants in the panel, regulatory overhaul is done. The new regulation, Basel III, is now in place. I think technology will in the future drive the pace of innovation, and we will have to move to a new equilibrium there. And bank sector restructuring in itself must accelerate because we are, based on a number of indicators that you can use, still overbanked. So I think consolidation will accelerate. Mergers and acquisitions will occur in the future, not to create national champions, mega banks, because that would only increase systemic risk. It should be cross-border, but for that, of course, we do need a true banking union with a true single banking market, it was already mentioned, which we now not have, including European deposit insurance, for example. We need to move on with that regulatory agenda. And I hope this will lead in the future to more diversity, not sheer size, but really diversity in bank business models. We need a very diverse bank ecosystem to serve the real economy and to contain systemic risks in the system.
Thanks, Rudi, for this interesting overview and interesting questions as well. I think we have a lot of issues on our plate, so we need to be a little bit focused because we are a bit running out of time. I would suggest the following. I give every panelist the possibility to react on what he or she heard from the different interventions. I would like to point on two, at least two, but feel free to add others. One which is coming back, especially in Rudi's presentation, on the profitability, how to resolve that issue. You've given some way forwards. My question there was related to your last point on the famous debate on the mergers and acquisitions in Europe, and I would like to have your views on that particular, because the question is, do we need more? And what is hampering these cross-border mergers and acquisitions? Is it fragmentation imposed by regulators or supervisors? Is it the lack of added value to have these mergers occurring in the European market? There I would end the last question, do we need ever bigger banks in Europe? So that is one issue. A second issue, and that is certainly also for Christine important, what are the challenges ahead in terms of, we have heard it, the profitability is still subdued, not in your institution, but overall, but there are challenges ahead for all institutions, and then reference is making to fintech, digitalization, new competitors, but also there's still the monetary policy, which is still continuing with extreme low interest rates, which is affecting, I think, the business models. So two issues, but feel free to add some others. We have for each 2 minutes. I would like to start with Mathias.
Thank you, Jo. These other presentations were quite interesting. I think that on do we need bigger banks? I think we have, on the one hand, indeed, we are very far from a single banking market in the Eurozone, Belgium being a bit of an exception. So 50% of the balance sheet here are from foreign banks, either having subsidiaries or branches. but we are number 6 in terms of size of the banking market or GDP in the Eurozone. The top 5, so from Germany to Netherlands, it's 90% of the domestic market share is 90%, so the foreign market share is only 10%. So indeed, we are not at all in retail banking in integrated market. So you could see, okay, let's try and have cross-border merger. That's a way to not increase necessarily the concentration within each market. Why not? This being said, let's face it, we tried that some years ago. It was called Dexia. It was called because that was a cross-border merger, and the Commission applauded the Europeanization. Then what happened with Fortis, Santander, and RBS, and ABN AMRO, that was also. So it can go wrong because there is always a lot of, especially we have takeover battles and the like, it can be dangerous, especially in a world where, let's face it, in terms of over-regulation, one can definitely argue that there can be too much complexity in terms of local, I agree with Christine on local versus your area regulator. Of course, there is a banking insurance model, which is a bit specific to Belgium and KBC in particular, which is not the norm, and indeed the banking union is only banking and not insurance. On the other hand, I don't think we've gone that far in terms of capital. Yes, much, much further than Basel II, but when you start so low, roughly we still have leverage for many, many banks of the order of 25. Equity is like 4% of the balance sheet. And so if you start going into takeover battles with that, I think it can be dangerous. So I wouldn't go too far on this. We should first try and complete, in particular, loss absorbency capacity with BRD and so on. So have to have really, for example, 8% of non-risk weighted loss absorbency of capital. So I think that's quite important. On the issue of over-regulation beyond that, as I say, I don't think there is over-regulation in terms that we insist on too much capital, not at all. There is too much complexity, but having sat around the table in Basel on the complexity, let me tell you, it's endogenous. The reason why we have so much complexity is because every country wants that its banks are okay. And then on top of that, big banks, they want to keep taking advantages of by far the most complex element of the system, which is internal models. And internal models are a way for banks to economize a lot of capital. In comparison to small banks that have the standardized approach, it was already a very complicated compromise to say that the advantage you can get from internal models cannot be more than 27.5% in 2025. It can be up to 50%. You can cut your capital need by going internal model by up to 50% until 2020. And let's face it, it is a problem, so it is a subsidy in a sense for big banks. And the jurisdiction that really wanted to keep this was Europe. So this is, and it was, by the way, not Southern Europe, because Southern Europe, they have high risk weights because they've had a lot of trouble, but it's Northern Europe. And in particular, let's not name names, except that I will, so it's Germany and France in particular. They are very interested in keeping that. So I think we need more capital before we embark on allowing for bigger banks, cross-border and the like. Thank you.
Very clear. Christine?
Yeah. So just also in 2 minutes to react on 2 elements. I mean, first of all, in terms of mergers and acquisitions, well, the impediments for doing mergers and acquisitions, which did not take place over the last years, of course, they are known, so I'm not going to go into detail in that. What about the future? I do think that we will see more mergers and acquisitions because of the fact that indeed, I mean, not only the business model, but also the profitability, of course, of the sector is under pressure. We will need to go to more scale. And in certain areas When you look, for instance, to back office or to IT operations, at first glance, the scalability is there, and so this will be exploited. Where I'm a bit mitigated, certainly also when I look to our own storyline and to our own history, well, that is, will it boost or not profitability? And that is for me a different story. We, within KBC, because that was also one of the questions that you raised to you, within KBC we have, even throughout the crisis, our diversified model, our indeed integrated bank insurance model combined with our asset management operations in the different countries that we operate in the model, in the Pearl model that I quickly highlighted here, i.e. to give also decentralized power in terms of local embeddedness, but to, of course, to be central where needed. This is quite successful at this moment. I do think that if we go into more consolidation, it will be of another nature, because we're always talking about banking consolidation. But there is so much going on outside of the pure incumbent financial industry. So we might see a consolidation of another nature where the regulator, I think, also needs to reflect upon. And then my second minute on what do we see in terms of challenges going forward. I do not fully agree with Rudi when he's saying that the technology is driving the pace of innovation. Is the client. The client behavior has changed completely over the last years. The client is much more impatient, much more knowledgeable. The client wants to have a proactive information, needs to be instant and all in one. And to do this and to give a good answer to these expectations and to this changed behavior, you need to invest. And some entities, some banks will be able to do so, and some will not be able to do so. But I think this is a trend. Digitalization is there to stay. This cannot be changed, and technology is not driving this. Technology is for us an enabler to do that. And the last element in that, we do not see fintechs as an enemy. I think that the financial sector also tended to think that they were able to do everything themselves. And I think we need to come away a bit of that. So we are co-investing, co-creating, embracing also the fintech sectors, because I think we are there in a win-win situation.
Thanks, Christine, for this message. Your 2 minutes.
Yes, let me use 2 minutes for 2 points. First, as a matter of fact, I would like to make a female alliance, maybe on governance. I would like to react, although maybe I will not go as far as Christine Lagarde, saying that Lehman Brothers would not have happened if they would be Lehman Sisters, but still, I would like to highlight that I think this is a major area that we still have to, I would say, use much better. I know that several banks have made high progress on that. Nevertheless, when we as EBA have wanted to issue many rules on governance, and you know this very well, we faced very high oppositions or difficulties. This is normal to some extent because this is cultural, very much ingrained, so it's difficult to move. It's also difficult to put in rules, to code, I would say. But this is an area where we have to put a lot of strengths, in my view. If you would ask the most common, I would say, supervisor, they would say, any bank, and especially medium or small, the first thing is to the quality of the management, and okay, that's it. Huh? So this is the highest asset to preserve, and we need to do still a good deal there. I would even think that if we are very good and successful in this area, it could come as a kind of a deal breaker in accepting much higher simplicity, I would say, and give up on some sensitivity or complexity of the rules, because we would trust that we are successful in having such a high profile, I would say, management. My second point is indeed on the deepening of the single market for banking. First thing I would observe is in the long, well, it's not so long, in the list of GCs, Europe has by far the majority of the global players, which I would tend to read that we have competition here, as a matter of fact. So we have a long list of big players, as well as a long list of small players. I think the landscape here is a bit, I would say, tailed in two ways. That's the situation. So I would see the role of the regulator as kind of business model neutral, but for sure making it easy for the market to move. And I'm concerned that we see that the move is very slow. It's not intuitive that it should have been so. So maybe we have to make sure that there is no impediments from our end in the market being on the move as necessary. We know that we have several issues to overcome, not to mention the European deposit and Pillar 3 and so on. But I think we have to accept and dive onto the practical daily things that we have, like do better on the ongoing home-house relationship, how to optimize the capital allocation with a European perspective, not to capture unduly at least capital, liquidity, or even MREL. Now we are at this stage. So we have to approach this humbly in a practical manner. I was there, I think it's 2 years ago, listening, not in the panel, but Lorenzo Binismaki was here and saying we should still dream about Europe and make solutions operational for the time they are needed, even if it didn't draw us. This we have not done for decades, so I would like to do that.
Okay, thanks, Isabelle. I think the last point is for another debate of 2-3 hours, but 2 minutes for Rudi, and then I give the floor to the audience.
Just to react on what has been said, I see mergers and acquisitions not necessarily to create big banks, but as a sort of natural way to shrink the banking system. Because if you look at many indicators, we are still overbanked, not only in terms of the number of banks, but also the size of the activities that are being undertaken. If you look at post-crisis, in many countries, total balance sheet of the banking system has shrunk quite a lot, without any impact on the real economy. So it were mainly activities that were benefiting the banks themselves, but not necessarily the real economy. We have some way to go there. And if I make the link with what has been said in the previous panel, everybody is agreeing our productivity has to improve in order to improve growth. Well, that means that all sectors will have to improve productivity, including the financial sector. If you look at those indicators, that hasn't happened over the recent past. So we need some extra input there. And if you look at economies of scale, the literature there, 10 to 20 years ago, the consensus was it's a U-shape. That U-shape has flattened a lot. And when you read papers, recent papers about that, they all ascribe it to the impact of regulation and compliance. Isabelle was referring to the 10,000 pages. Some banks can afford that, some not. And also the investments that are needed in technology, cybersecurity, etc. This will require serious resources, and not all banks will be able to do that. And a final point is, what strikes me also is, we talk a lot about capital market union. Next to banking union, we want a capital market union, not to be so dependent on banks only. But if you want to develop that, you need the capacity and institutions to do that. And for example, our investment banking capacity in Europe has shrunk dramatically post-crisis. I don't see that as a plus, and I would see their cross-border mergers as a means to improve our investment banking capacity with deal-making capacity here, and not only being dependent on the Americans, for example.
Very interesting, and thanks to all the panelists. Before lunch, there is room for, let's say, 2 questions, very quickly. We take two questions, and I see another question over there. You first.
Okay, thank you very much. I would like to raise a question about part of the analysis of Rudi van der Vennet. I really enjoyed his presentation. I think I agreed with most what he said, but there's one thing I'm not sure about, and which is the following. I agree that most banks strive for return on equity above 10%, arguing that this is what their shareholders want. And I would say, if we are talking about normal businesses, this is a proper line of reasoning, right? Because if you are a non-bank listed company, then of course you should listen to what your shareholders want, because their money is at stake. You know, if the firm fails, in the end, you know, the shareholders lose their money, and that's why they demand a particular return on equity. But for banks, I think the situation is fundamentally different, because if a bank fails, you know, most of the time, at least if we're talking big banks, they will not fail. Yeah, it's not the shareholders in the end who will pay, it's the taxpayers. Yeah, so from that perspective, is it reasonable to follow the same methodology, the same thinking, and say, okay, if shareholders want an ROA of more than 10%, then that's what we should deliver.
Rudi, you had a question? Sorry. Yeah, take the one. Yeah, go ahead.
Christoph Hedrich, SUERF and Commerzbank Frankfurt. I think it was very valuable to listen that banks are not earning their capital costs. That is a pro-cyclical industry. Okay. My question is this lack of profitability in the core business perhaps interlinked with regulation and short-termism? It was an idea of the regulator to calculate the PD on 1 year. So do not we need more incentives for long-term perspectives in banking and more profitability in our core business? And then pro-cyclicality would disappear perhaps.
Rudi, the last one, and then we close.
Thank you, Jo. Rudi Bonte from Deloitte. I was looking at the title of the panel, and prudential policies is at the core of all this. So I have a very blunt question, and I will explain why I have that question. My question is, can a systemic risk be caused by supervisors or regulators? So I think there are 5 flashing signals why I ask this question. The first one is, I see a lot of supervisors losing momentum and weakening the safety measures which they have agreed so many years ago. Second point is standardization. Mathias, you talked about the models, and I'm sure that the Basel Committee is looking very carefully at the unintended consequences of the new rules. But I can imagine that for some banks it's quite tricky. They have models, and they have to optimize their business and their models by relying on standardized approaches. So is there not a contradiction in this respect? The third point is the reactiveness of some supervisors. We see still too much focus on risks of the past. When I see NPLs, for example, it's always the same issue, but what about emerging risks? Are you looking enough at all these upcoming risk areas? And then the 2 last points, it was raised already somewhere, is the lack of coordination. I think there is a lack of tuning between supervisory authorities and other authorities. Let me just mention AML, data overseers, cyber watchdogs, much more room for improvement in the interaction when looking at the emergent risk. And last but not least is trust. We are 10 years after the crisis. We know what happened with our neighbors in the north and in the south when dealing with the big banks. So I can imagine, Mathias, when we talk about resolution, that in some countries, resolution authorities or supervisory authorities are schizophrenic. They plead for a single point approach when they are home supervisor, but at the same time they are host supervisor, and then they are doing ring fencing when they are confronted with actions by the home. So that is the reason for my question. Thank you.
Okay, I'm afraid that the answers will be a little bit more complicated and we need to close. Who wants to react? 1 minute,
Yeah.
Christine?
Just reacting on all the questions a bit together. One, in terms of profitability, we look to sustainable profitability through the cycle. This means that when we are looking, for instance, to budget cycles, etc., we are not just looking to 1 year or to 3 years, but to how sustainable this business is through the cycle. And there we take more elements into consideration than only the 1 year in order to avoid to the maximum extent possible pro-cyclicality. It's also important that as a financial institution you determine your risk appetite and that you check also throughout the cycle that you remain within the risk appetite. This does not mean that you will have years where accounting-wise you will have a hit on your P&L, but this needs to remain within your risk appetite statement. 2, can systemic risk be caused by regulators? I'm sorry, I'm not going to answer that question in that order, but in an inverse order. I do think, Rudi, that regulators can do a lot in terms of macro-prudential frameworks. Example is indeed the mortgage market in Belgium. We would be very much in favor of having a more strict framework in this respect, as we see also in different other countries. And on the other elements I have already elaborated on.
1 minute. Last word for you.
On Jacob's question, is return on equity the right measure? At some level, no. If equity holders only put 4% of the balance sheet, why should they have all the power? At some level, I mean, I'm being provocative here, but I think one thing I would push for very strongly, it was an idea already in Erkki Likanen's report, let's have managerial incentives not linked only to equity, but also to risky debt at least. I think that would be helpful in terms of making the system safer. On Rudi's question, supervisor indeed could do more, should do more. One problem is that they have masters, politicians and so on. It's normally in a democracy, but some politicians have, I think, amazingly, it's surprising that it's so fast how they seem to be losing the understanding of the crisis less than 10 years ago, or now 10 years ago. And indeed, the push by too many politicians is about less regulation, less capital, and so on. And I think that's potentially quite dangerous. So we have to fight it, and especially it's also something that benefits the healthy banks. The healthy banks are the victims of a system where the supervision regulation is too weak. And I think we've done a lot of progress in Europe. We don't want to turn around because of political constraints. And the fact that I just heard that this morning Mario Nava, whom we all know, who was at the Basel Committee, was at the Commission and so on, and was now the head of Consob, so the equivalent of FSMA, just resigned, pushed by, let's face it, the populist government in Italy. And I think that's very, very worrisome.
Oops. Okay, with these wise words, I think we have to close, unfortunately, because lunch is waiting. I would like to thank this very distinguished panel with very rich discussion, and now lunch is waiting outside. Thanks.